The need for insurance starts from four important factors. One is called as the protection, followed by liquidity, followed by tax relief, and followed by money when you need it. Endowment means that it is an investment oriented plan. So it is not going to be just like a term insurance. It is an investment oriented plan which will pay you both in case of death and also in survival at the end of the term. Good morning and welcome to the second session of Unit 4 in Management of Banking and Insurance Services. And in this session, we are going to talk about life insurance. Now, what can be more important than a human life? And what is the value of the life? We certainly have a lot of questions like this to ask about to the insurance company. So let us go forward and try to understand what is the meaning of life insurance and why it forms a very, very important part of our day-to-day life. Now, the introduction to the life insurance starts like this. It can be termed as an agreement between the policy owner and the insurer, where the insurer may, for a consideration, agree to pay a sum of money upon the occurrence of the insured individual's death, any terminal illness, critical illness, or maturity of the policy. Now, the understanding of a life insurance begins with the concept that moment you are trying to go in for an insurance, that means you are trying to cover up all the risk that is going to happen in your day-to-day life. So, for example, if the person who is paying the premium to the insurance company suddenly passes away because of some accident or because of some illness, or he is completely paralyzed, or he is completely hit by some disease altogether, by which he is not able to go forward and continue his normal walk of life, then automatically the insurance company will pay the beneficiary the necessary amount that is being mentioned in the insurance contract. Now, in case, let's assume that for a good purpose, nothing happens to the insured person, he is living his life as healthy as possible, then what happens at the end of the insurance term period, that is upon the maturity of the policy, you will be given, that's the insurer will be given the amount of whatever that the policy has mentioned. So when you look into the life insurance concept itself, it is very, very important, and it is very naturally framed in such a manner that life is being adjusted, life is being prone to a lot of accidental factors, life is being prone into a lot of untoward incidences which needs a backup, which needs a coverage altogether. That's where the life insurance comes into picture, and their main aim is to cover the life upon any kind of incidences happening like this. Now, the functional definition of insurance. In India, insurance is not new. Insurance started as old as the Vedas. Why? Because when you look into the logo of LIC, the two hands covering a lamp and a very beautiful words that have been written under that particular logo, it says Yoga Kshemam Vahamayam, which means to say that life at its glory, life at its fullest altogether, live a life with glory. So what happens here is that we have understood the concept of life and the importance behind it right during the time period of the Vedas itself. It has been told in the Rig Veda, which is the most ancient form of Veda. The real insurance factor that can be tracked upon in India started up by the Bombay Mutual Assurance Society way back in the year 1870, followed by which there were many companies like the Oriental, the Bharat Insurance, Empire of India, who also started up the insurance business in the same year from 1870 to 1890. Now, what do I mean by saying here is that insurance is something which is as old as possible to the Indian context, but many people were not aware about the life insurance or the consequences of taking the life insurance. So what used to happen is that the range at which the insurance sector was working was on a very, very slow pace. Most of the people were not completely aware of how insurance works and why we need to go for it. Followed by the need for insurance. The need for insurance starts from four important factors. One is called as the protection, followed by liquidity, followed by tax relief, and followed by money when you need it. Now, why do we say this? At any given point of time, the one proverb that we need to keep in our life is that prevention is better than cure. In the similar manner, protection is always better than the illness factor. So insurance is an agent, is a tool, it's a weapon that is used to protect us from any kind of emergency or exigency. The reason why people ask you to take an insurance coverage is to protect yourself from any kind of factors that can happen altogether to you in life. So that is why we say that protect yourself at any given point of time. Please do not take insurance as a burden. Please do not look at insurance as something where you are just investing money altogether. But insurance is a very, very valid coverage which will protect you at any given point of time. So that's why I say that insurance is a very big protection agent. Followed by the liquidity factor. Now, whenever we have talked about liquidity, it is all about the factor of money being collected in one place for utilization. So liquidity is always available with the insurance company, which can be used at any point of time to help the individual. Suppose you need any money for emergency, or you need to take back some money in terms of some valuation, some business altogether, we call this as the liquidity factor. Followed by the tax relief factor. What is a tax relief all about? Tax relief is all about when you are paying this premium or when you are paying the insurance amount, this is actually like a beneficiary for you from which you will be able to get some tax relief. You will be able to get some, a free amount in terms of saving yourself from the tax that has been predicted by the government. So when you start saving money in insurance, that money can be saved against the government taxes. And similarly, whenever you want money, you can cash upon the insurance factor and get back in terms of emergencies. Followed by the types of life insurance. When we talk about the term life insurance, the endowment, the permanent life, and the unit linked plan. Term life insurance which means to say that on a particular term basis. Of course, we would be talking about it in detail. When I say a term life, that means it's fixed for a number of years. Endowment means which is where you are going to go for a specific term factor or on a specific sector altogether. Permanent life insurance is for your entire life altogether. And when we are talking about unit linked plan, that means these are insurances which are linked to the market situation. They invest in mutual funds or shares or equities in the market. So they are unit linked. So each unit that has been linked to your insurance will have a proportionate value. Now moving forward, let's try to understand the meaning of term life insurance. Sum assured is payable only in the event of death during the term. So the first condition here is that in case of any eventuality like death, only death, then the sum will be paid back to the insurer. So that is why we say that sum assured is payable only in the event of death in case of the term. That is very, very important here. In case of survival, the contract comes to an end at the end of the term. So suppose you are alive throughout the time period, at the end of the time period, at the end of the maturity, the contract comes to an end. The term life insurance can be as long as 40 years and as short as 1 year. So you can have a term life contract insurance for 40 years, and you can have a minimum value worth up to 1 year altogether. No refund of premium. Very, very important factor. At any given point of time, there is not going to be any refund that is going to be given to you at any cost. So that's why we say that no refund of premium shall be given to you. Followed by non-participating policy. That means it will not participate into any market, any kind of events or any kind of market related associated activities. It's a single cover policy altogether. It will have a low premium, and this premium will be used only to cover that insurer in case of death or any eventuality. Moving forward, again, now the increasing term insurance, what happens here is that life insurance cover under this plan goes increasing periodically in the term of predetermined rate, that is the riders, decreasing in terms of the term insurance. So as you keep on going forward, there will be a lot of riders and benefits that will be added to you in terms of your term insurance. The sum assured, very, very important, decreases with the term of the policy. This is where you need to understand, as you keep on aging, the sum assured will start coming down. Normally, the decreasing term assurance plan is taken out from the mortgaged protection. So you cannot go for mortgage, under which the outstanding loan amount decreases as the time comes down and passes on with the sum assured. So as you keep on aging, the sum assured value will also start coming down. This is probably why, because you need to understand the amount, the chances of you living on this earth might be anywhere between, say, 60 to 70 years. So now, for example, if you are going to take an insurance at the age of 20, then you have 40 more years for you to live on this earth. So that means you have so much of time where the company also knows the eventuality of you passing away in between is very rare. But if you're going to take an insurance as you start coming towards 60, that means you are prone to many kind of diseases and your life term might come to an end at any point of time period given. So what happens as you keep on going up, the term value, that's the policy value, starts coming down. Endowment plans is an investment oriented plan which not only pays in case of event of death but also in the event of survival at the end of the term. That is very, very important. Endowment means that it is an investment oriented plan. So it is not going to be just like a term insurance. It is an investment oriented plan which will pay you both in case of death and also in survival at the end of the term. This is actually a contract underwritten by a life insurance company to pay a fixed amount as premium and the accumulated profits that are declared annually. So automatically you will get that benefits in terms of that factor. Premium includes two elements. One is your mortality element and your investment. The minimum age of entry is 12 years and the maximum age is equal to 65 years. So now what happens is that at the age of maturity is 75 years. That is the maximum at which you will be able to see this. Why do we talk about this factor is that if you start understanding here, endowment policy is something which is more attractive in nature. Why? Because you are going to get into a profit sharing mode. This is more involved in terms of market and its activity, and this will also give you money in case of survival at the end. So what happens here is that you are benefited from both the angles. It's not that only in case of death it's going to happen, or in case of any untoward event, even in case of survival, at the end of the time period altogether, you will get back what has been promised. And every year, when the company declares its annual profit, you will get a benefit out of that profit altogether. So that is why this becomes a very, very important policy altogether. Followed by the joint life endowment plan. Under this category, two lives can be insured under one contract. The sum assured is payable at the end of endowment term, death of either of the two. Now you also have a money back plan in this, an additional advantage of receiving a certain amount money back at periodic intervals during the policy term. So you have a two kind of thing, policies, where one side you can cover with one policy 2 lives, and in case of eventuality of death or anything happening of either one of the partners, the endowment money is given back to you. The other one is called as a money back endowment policy, where you are going to have the additional benefit of getting the money back after a certain period of time as mentioned as per the insurance contract. Now, the other one is called as the permanent whole life insurance, which means to say that whole life plans are another type of endowment plan which covers death for an indefinite period. So even after your death, there is some kind of factors or benefit riders which you will be able to get. When the policyholder dies, the face value of the policy is known as death benefit, and this is paid to the person who has been named as a nominee in the insurance. It can be with or without profit. So this is where it comes into picture. If you cancel the policy at a certain amount of time passed away, the insurance policy will be surrendered and the cash value will be rendered back to you. So if you understand the entire psychology here, when I talk about permanent, this is something the after death. That's why in life insurance policy, they always say that jeene ke baad, jeene ke saath, which means to say that even during the lifetime and even after the lifetime also. That's where the permanent whole life insurance comes into picture. Once the person passes away because of some factor, then automatically the nominee will get all the insurance benefits. In the other case, it can be either with or without profit. So there is a death rider benefit that comes here in this policy. If you cancel the policy after a certain period of time, for that amount, the rendered cash value that has been surrendered, you will be getting it back in terms from the insurance company. Moving forward, we will also be talking about the ordinary whole life insurance, which we are just going to cover in terms of making the premium payment. And for that premium, you are going to be protected. So after the death, whatever occurs and whatever is the factor value, you will be getting back that value altogether. Then you have a limited payment whole life plan. So when we talk about the limited payment whole life plan, it provides same benefit as above, but the premium that are paid for a limited time period. Premium are sufficiently higher to cover the risk factor here. So when we talk about the limited time period kind of thing, here you would say that you will get all the benefits of that, but here the entire benefit is limited to a certain period altogether. With this, I come to the end of this session. I hope and believe that all the factors that have been discussed here is of a great help, of a great resource to you. In the upcoming session, we are going to talk about the different concepts of insurance and also about the non-life insurance product. Until then, stay tuned, stay blessed, and stay enlightened forever. Thank you once again for joining me on this wonderful session.